How's it going, everybody? Happy Wednesday. Welcome to the Hot Corner Insider Live Strategy Session. I am your host, as always, Steve Straza, Director of Research at All Star Charts, where we jump in and talk about what's been going on the past week. Let's get our disclaimer out of the way. Nothing we discuss here constitutes any solicitation to buy or sell any security. This is solely for informational purposes and not to be construed as investment advice. For more, allstarcharts.com/terms. Here's where we are. S&P 500, for me, it's the cleanest, right? We have a very clear level. I think what this level represents is the trend higher right now for the overall market. It's the S&P 500. And I think those August highs right here where we have the red arrow drawn is a clear line in the sand that tells us whether or not this reversal pattern, and this is a textbook technical rounding bottom, right, which is a trend reversal formation. And if we're above these August highs, I think that pattern is completed. And that means that the path of least resistance for stocks, or at least the S&P 500 index, so most stocks, is higher. New uptrend underway. Of course, if we look at the Russell 2000, looks a lot different. This would be the weakest index, right? So small cap stocks, not the leaders, that's for sure. Haven't been for a while, but not breaking down. This is called polarity. So former resistance at the 2018 highs and 2020 highs. Look at this beautiful breakaway gap, by the way, back in 2020. We got this nice base breakout after the COVID bottom. Now that former resistance has turned into support. Once, twice, 3 times, 4 times. You could say 5, now 6 times. Excuse me. So while bears can't take control of this critical level at these prior cycle highs of 170, around 170, bulls can't get much done either. And that is illustrated by this flat 200-day moving average here in gray. So the last couple of times since last year now that price has visited this level from above, it's rebounded pretty strongly, right? We've seen these strong automatic reactions. Does that happen again? Do we head back to the upper bounds of this range? Maybe. I don't see why not. There is a saying that technicians like, says the more times the level is tested, the more likely it is to break. Well, in the case of small cap stocks, these things are really on their last leg, right? If this level keeps getting pounded, it's only a matter of time until the demand at this level is absorbed. There's too much supply. Prices violate 170. And then I think things get really dicey. And the S&P probably doesn't look great in that environment either. Probably back below these August highs. For now, large caps at the index level. Damage has been repaired, right? We scooped and scored. We talked about these failed tops over and over and over again over the past few weeks. We got the automatic reaction higher off those failed moves. Wasn't as strong as I would have liked, but it was strong enough. Got some monster candles, some major follow through. Leaders looked good, right? So for now, I think all is okay. And bulls were able to make a save. But we got to see, where we go from here, obviously. The fact that interest rates continue to make new highs probably doesn't help. It's not the end of the world, right? It depends on the pace or rate of change or momentum behind these new highs and these rallies for yields. That can become problematic, right? We don't want to see rates rise too fast. When you hear in the news today that interest rates are making new highs, this is the US 30-year. Remember, that's what tends to happen in uptrends. And I don't know if maybe we're all just so new to this kind of an environment, because as you can see, shown from the left to the most of this chart, from the left-hand side, 40 years of consistently lower interest rates year in, year out. talk about a downtrend, I don't know, maybe the news and the headlines and the media pundits have to get used to an environment where we have to talk about higher interest rates. Every couple of months, new highs from interest rates. Worse than that, though, is that the dollar's been doing the same thing at least for the past 3 months, right? So the little arc down here, so this is now the dollar overlaid with the 30-year yield chart we were just looking at, but zoomed way in just to show this year's price action. So we had a sideways dollar for most of 2023 after the dollar really came off the highs hard in the fourth quarter of last year. Sideways consolidation. But since July, this arc here is actually when market internals peaked, right? The new highs list for the stock market peaked. Dollar starts moving higher. Interest rates start moving higher at a faster rate. This is going to continue to weigh on risk assets. Interest rates will impact some groups more than others. For example, and we'll get to energy in just a minute, some stocks, commodity stocks, tend to do okay in a rising rate environment, but a higher dollar tends to be no good for anything. Across the board, don't want to see a stronger dollar if you want to see higher stock prices. And it doesn't mean or indicate that there won't be certain pockets of strength and that there won't be winners. It just becomes a more difficult environment to make money on stocks in as we head into the end of the year. If the dollar and interest rates every couple of weeks keep making new highs. Elsewhere in the market, I thought this chart was interesting. I wanted to bring it along. It's earnings season. The banks always kick off earnings season. So far, so good. Morgan Stanley, bad report today. But outside of Morgan, the big banks did okay, which isn't a shock, right? It's the regional banks doing okay that is a bit more surprising. And they've been doing okay too. So more reports to come. Like we were talking about this morning on the morning show, we got to see these California banks, these West Coast banks. That's probably where the cracks will show, if there are any, in the banking sector. But how good has this anchored VWAP been? So, Brian Shannon, dear friend and mentor, will tell you, anchoring the volume weighted average price indicator is very much an art. So why do I have it from this, random low in May? This was the banking crisis low. This is when First Republic went out. And over on the way left-hand side of the chart, this was the original bank panic, Silicon Valley. Boom, boom, boom. We went sideways for a while while people continued to worry, figure out who was going to be next. First Republic, that was in May. And off of those lows, the VWAP has acted as a really, really nice signpost, right? Where any sort of corrective wave has been met with buyers at the VWAP, and then there's been a resulting bounce. Does that happen again? We overshot a few weeks ago. I think the market was pricing in some weak bank earnings this week, next week, following week. So we did undercut that VWAP, but then we hung out, and now we're trying to get back above it. Today, again, I'll check financials. It's 120 here on Wednesday. XLF, not great. Down more than 1% today. And if you look at the bank indexes, they're trying. Some long lower shadows right now, but both of them down almost 2%. All right, so those VWAPs are right here, very much in play. Literally trading on them right now. I think these levels need to hold. If they do, very encouraging for the broader market. Regional banks are one of those lagging areas that I would expect to lead if there's going to be further downside from here. They should be some of the first to break down. If they can stay above this VWAP, get through earnings season, very constructive for the broader market. That's something we're keeping an eye on. Energy. We were on here, I think, just last week or the week before talking about energy needs more time. They must have heard me. XOP, which is the oil and gas exploration and production ETF, it's been up like every single day since early October. 1, 2, 3, 4, 5, 6, 7, 8, 9 out of 10 of the last, 9 out of the last 10 sessions been green in XOP. Reemerging as leadership. What we're looking at here is equal weight energy, RSPG. Looks pretty good as well. Looks actually better than the cap weighted ETF, XLE. And it's really about these ranges. RSPG, the equal weight version, is a little bit cleaner than XLE, which is why I've zoomed in and showed it here. As soon as these ranges resolve, you do want to be involved. You want significant energy exposure. We think the bull market continues to rage on. This is kind of just a breather period, right? And actually, if you go back, this has been a year and a half now. This was early summer, late spring, last year, just consolidating. And if I were to zoom out, it would look like this. Off those COVID lows, just fierce uptrend. These were your leaders. 2020, 2021, 2022. Energy stocks, best sector in the market. See that relative trend here, surging higher. And then both of these trends, both on an absolute basis and on a relative basis, have gone straight sideways for a year and a half now. If and when these ranges resolve, let's go energy. And what makes these ranges resolve? The strongest stocks beneath the surface breaking out of their ranges. Hess comes to mind, right? Hess is one of my favorite. If you look at the new highs list today in energy, it's large cap energy, we got Hess, we've got Halliburton, we've got Diamondback. We wrote about Diamondback. It came up in our Young Aristocrats post. These guys, not only have they raised their dividend for 5 straight years, but they also pay like a special variable dividend, which a lot of these energy companies are doing right now. So Hess, one of the few to make it back to new all-time highs already. Not many energy companies can say that. So Hess, monster base on base formation here. We've been long against 130, but I think this trade gets a little bit sweeter now that we're getting this consolidation breakout after the larger base. 160 is another good entry point, trading a little bit above that, around 166 here today. So 160, if you're not already in it, you could define your risk right there at those pivot highs from last year and earlier this year, and trade this one back to about 195. ConocoPhillips, it's another one. Been a Form 4 buyer in Q1 of this year. Not as clean as Hess. We've zoomed in a little bit more here on the Hess chart. Not as clean, but you have the base breakout and then a consolidation right above the upper bounds of the old base. 127.50. Once we're above there, I think ready for a new leg higher. That takes us to 193. Earthstone Energy, that's ticker symbol ESTE. $3 billion. Mid cap. Maybe even a small cap. Earthstone Energy, president and CEO. Small purchase, 116,000. Nice base off the COVID lows. Big consolidation here, 2250-ish. Those pivot highs from 2022, if we take that out, we're ready for the next leg higher. I think that takes us back to those old all-time highs, 3580. Oops, hold on. So participation should broaden if we do get a breakout energy on a broader scale at the index level. We should see participation broaden beneath the surface, which means oil field services stocks should stay hot. They've been hot. They've kind of been the leaders through this corrective wave. E&P probably reemerges as leadership. That's usually where the beta is for energy. Usually it's also like there's a time component where earlier in the commodity or energy cycle, it's the explorers. And then later, as more and more supply comes online, and these energy companies get all bulled up, start adding supply, adding new rigs, then the oil field services come and do better and lead in the later innings of the energy bull market, right? So it shouldn't be a shock if that relative strength does shift more sustainably to oil services, but I kind of want to see it. Point is, you want to see all of them participating, not just the E&Ps, not just the services names, but also the midstream operators. So here's the Alerian MLP ETF, AMLP. These are the pipeline companies. A lot of them, just like this fund, are LPs. What a clean level. Talk about, a nice uptrend off the COVID lows and a long consolidation here. Just like what we've seen in the other groups, right? Maybe a little bit longer here for the MLPs. 42, what a clean level right above those pivot highs. If you want to get involved at the index level, I like this as a vehicle. Pay you 7.5% yield. So AMLP above 42, target of 66. All right, let's hop over to coal quick. We're going to talk about LPs. We're going to talk about these midstream operators. Alliance Resource Partners, coal producer. Pays like a 12% dividend. I talked about it. I don't know if it was on here or another show, but I got long this name a few weeks ago. The trade's been working really well already, but it's really not a trade, right? I'm interested in the 12% yield. They've been growing it like crazy for the past several years now. That's what happens in commodity bull markets. These companies go from paying no dividend to all of a sudden a monster dividend. I think they can easily service it. Price to earnings multiple on this company, which is hard to say because their earnings vary so much during bull markets. They really grow fast, but it's like 5 times, 5x PE, 12% yield. Beautiful base. We're above 22. I love it. That's a 38% Fibonacci retracement. First target 34. I think we go back to those old all-time highs. Coal stocks look so good. And this chart I had to bring along. This is the same stock, ARLP, zoomed all the way out. In the lower pane, I'm showing you the consecutive numbers of up days. Consecutive green candles, daily win streak. 13 straight last month or the month before. So it just speaks to the relentless demand for this and other coal stocks. And if you go back throughout history, when you get these monster win streaks, it's not the end of bull markets, right? I think that's what this is too. Big, big rally off the COVID lows, 2020 lows. Nice correction here, tight little pennant or flag. We rip higher. Going back to those all-time highs. So we like ARLP a lot. Show it one more time. Initial target 34, but really I'm interested in these all-time highs above 50. That's where I think we go. Antero midstream, another one, ticker symbol AM. Again, looks like the others. Off the 2020 lows, big uptrend, straight sideways, very constructive consolidation, clean level, 1170 is those pivot highs, above 1170, target 14 3/4. Total, France. It's a French multinational, one of the bigger oil and gas operators out in Europe. Virginia Fox, House of Representatives member, buyer last May. Got a nice base here. Not my favorite. It's not the best. Does give you international exposure. Pays a nice yield. Don't know exactly what it is, but I know it's up there. TTE, we're above 65. Those are those prior cycle highs too. 65 to 91, not bad. Give you about 50%. Let's talk about some of these tech stocks right now. I know that we have more than thoroughly covered the mega cap growth trend over the past several weeks. But some are just continue to stand out. Adobe's one of them. Look at the candle today. Look at the candle yesterday. This is a stock that wants to go higher. Buyers are in control. 537. It's a clean level, 62% retracement. Why wouldn't this one go back to those old all-time highs? Just like we think we'll see from Google and Meta, and have already seen from Microsoft and Apple, and that and more from companies like Nvidia or Broadcom. I don't think Adobe will be any different. 537 is a clean level. If you want confirmation, I think you get that on today's move above 567. Pivot highs from September. Target of 700. And the CFO was the insider in this one about a year ago. About a year ago. Did he pick the bottom? I mean, what do I say? What do I always say? Pay attention when it's the CFO, guys. So, wow, I'm just noticing this. So let's check this out together. Real time. Adobe gapped lower after its Q2 earnings report, September 15th of last year. Oh, terrible looking candle. 17%. It fell. That was September 15th. Stock basically bottomed on September 26th. Might have made an incremental closing low on September 30th. That was right here. That's when the CFO came out and bought $1 million worth of stock. So thank you, Adobe CFO. I'm going to look more into this and tweet the chart out later. This is why I come on here and say over and over and over again, tell me when the CFOs are buying. I want to see the names that the CFOs are buying. They know better than anyone. They talk about these things in their office at night when they're doing the monthly close. Hey, Wall Street's offsides. We're going to kill these earnings estimates. It's their job to know these things. So some of the best information that we get from insider filings comes from CFOs. Great example, seeing it right here, right now. The Adobe CFO was out here buying stock at the lows this time last year. He's already doubled his money. Pretty good. Pay yourself a bonus. Why not? All right, so 537 long towards 700. Love that insider activity. What's one that I like even more than Adobe? Palo Alto. Just got this insider filing. Maybe Mark Wayne Mullen, senator, is also a technician. I don't know. But he's buying the breakout in Palo Alto. This chart looks as good or better than any right now. New all-time highs on absolute terms, new all-time highs relative to the broader market, even breaking out relative to the NASDAQ 100, which is a benchmark that most stocks can't beat. So PANW, as hot as any stock right now, very clean level, right? Clean chart. Nice base, leg higher. You shook lower below these 2022 highs, rocketed off that level, kind of stayed in this range. Now we're getting a resolution. 263 is the level. If I were to zoom in, I'll give you exactly what those pivot highs are. 258, 259. Yeah, 259. And if I zoomed in on this chart, we're just zoomed out on daily here. But if you zoomed in just the past 1, 2, 3, 4, 5, 6 days, really tight flag right above where this red arrow is drawn, like the past 5 days. Yeah, I think this thing's ready to rock. We like cyber stocks as much as any right now. You know, when the Israel-Palestine news broke a week or whatever, a week or two ago now, all you hear about is oil and aerospace and defense stocks, which is normal whenever there's a geopolitical thing. It's crude oil and A&D stocks. You should have seen cyber stocks, though. They were the real winners. I don't know why. I don't know if that makes sense. I don't know if it has anything to do with it. But some notable relative strength there. I don't know. Cyber stocks are showing such impressive relative strength. I think, you know, we talk about cyber as technology most of the time, but it's really internet, which to me is communications. Communication stocks at the sector level, XLC, making new highs, pretty much. I think cyber is the strongest group in that sector. First cash holdings, it's a pawn shop. FCFS. Is this telling us gold is going higher? So FCFS, nice base here. Yeah, so 105, 106. Above there, this is a valid upside resolution. First target 141, that's first cash holdings, FCFS. Then we have C Limited. This is Southeast Asia online retail. Only reason I'm talking about it is because I know we've talked about it for the past couple of weeks. We are feeling bullish. This is a counter trend trade. It's a cute trade, but it is one of my favorite patterns to trade. So I'm involved. It is working. Not many things are working right now. So I figured we would, you know, just take a little victory lap here. 41, 45 second entry. I think we get 56 soon in this one. So many things are working right now. Sorry. Just checking out the chat quick before we go. So from one hole, wouldn't dividend stocks lose their value, at least relatively, since it's generally from mature companies that don't have much more room for growth. I'm not sure what you mean. I forget what I was talking about. Higher rates and higher energy both should push down equities in general. No. Listen, energy stocks are like the Notre Dame of markets. They don't belong to a conference. They don't move with the other sectors. Energy often gets tagged as defensive. A lot of times it gets tagged as pro-cyclical. Most commodity stocks are, but energy is really just energy. And it wouldn't be the first time that we saw energy working really well while most other things don't, right? Or vice versa. There have been plenty of markets in my career where energy is not working and everything else is. So I wouldn't overthink the correlation of energy to anything but energy futures and crude oil, right? And if those charts continue to work up and to the right and inflation expectations continue to work up and to the right, which they are, then I think energy stocks keep moving up and to the right as well. All right, guys. Thank you, everybody, as always, for joining me. We will be right back here, same time, same place, next week, Wednesday at 1 o'clock. And tomorrow and every weekday, join us 8:30 in the morning for the morning show. See you there.